All righty. So we're going to look briefly at 2021's tax rates, and then what we're going to do is we're going to talk a little bit about where CNR is thinking we're going from a tax standpoint. And they do a lot of study. They put their fingers in the air, try to figure out which way the wind is blowing relative to all the policies that they're touting out there. And this is kind of what they came up with so far. First, let's talk about the tax rates. As you can see, there's not much change between 2020 and 2021. For example, a single individual at the 10% bracket, their bracket went from a cap of $98.75 to $99.50. And on the married side, it jumped $150 to $19,900. So it kind of worked like that all the way through. So we've got another year of some pretty decent tax brackets to do planning, because at the end of the day, it does look like we're starting to run out of time here to get the planning done to make sure that we don't get absolutely rocked by what appears to be coming down the road from a tax policy standpoint. If you look at the standard deductions, Rocky talked about what they were for 2020. In 2021, they're increasing again. A married couple filing separately or single individual, theirs is going to go up by $150 to $12,550. If you're a married couple filing jointly, the deductions increase $300 to $25,100. So again, that just keeps the taxable income down for you. So between the current brackets and the current standard deductions, this is really going to be one of our best years as taxpayers to be able to strategize and get ourselves in a better position moving forward. At this point, like I said, 2021, it does present opportunities. We really have to be looking at our long-term tax mitigation strategies and seeing whether it makes sense to double down this year or just increase the percentage of dollars that we're converting so we are in a much better position moving forward. Now, let's talk about CNR's take on the tax proposals. And what I'm going to do is I'm really going to talk about the different areas that look like there is a high propensity of change coming down the road here. So one, when you think about the Tax Cuts and Jobs Act, again, this was something that was put together during the Trump administration, and it was a big part of the Democrats' platform moving forward. And they are, if you think about it, the thought is we need to pay more taxes to get the debt down. And I get that. I really do. We can't keep spending like we are and expect this debt to go away. It's going to have to be paid for. We all know that. We all know it's coming. Now, right at this point, the Tax Cut and Jobs Act is scheduled to sunset or expire for most of the provisions in 2025. That's already on the books. Now, the question is whether the Tax Cut and Jobs Act will survive until the end of 2025. And by all accounts, from what is being said, the posturing and really the direction that City National Rockdale thinks this is going to go, they're not too confident that it's even going to make it that far. So what we're talking about is increased taxes coming a little bit sooner. Again, that's why 2021 is so important to positioning yourself for the future in the best tax situation possible, and that's tax mitigation again. So one of the proposals, if they do get rid of the tax cuts that we got through Trump, it's going to look like this. So on the left side of this page, you got the current tax rates. Okay, Rocky's already talked about them. I've already talked about them. If you move over to the right side of the page, it's the Democratic proposal, which again goes back to the old tax rates that we had. So there's a significant change. The three brackets that get hit the most, 12%, 22%, and the 24% brackets are going to increase the most. Kind of the heart of the middle class right there. And when you look at the center chart, it shows you the tax increase as a percentage. So think of it this way. If you were at the 12% bracket and the proposal says that we're going to go to 15, well, that's a 3% increase, and 3% is 25% of the 12% Tax Cut and Jobs Act rate. So you can see at 12%, it's going to go up 25. At 22% bracket, it's going to go up over 13. 24, it's going to go up over 16, and so on. So there is a significant increase there. And if our clients think back to the year after the Tax Cut Act went into effect, the average clients of ours were literally saving between $2,000 and $5,000 in taxes during that first year. And obviously the second and third year happened the same way. So when it turns back, just to get the mindset straight on what will happen if we go back to the old rates, you can expect to pay between $2,000 and $5,000 more in taxes. So it just gives you a little bit of perspective as to how much we're going to end up paying. Now, again, I have no problem with higher taxes as long as we're actually going to pay down the debt. If we continue to spend and don't pay down the debt, all we're doing is paying more taxes. So do you have a plan? And with our firm, it's always about planning. If you have a plan and you execute it, you make the adjustments along the way, you're going to be much better off in the future. If you don't have a plan and you just kind of going the way the wind blows, it's going to get a little bit topsy-turvy on you. So planning is always the key for this. Let's look at the impact of recalling the Tax Cut Jobs Act. You know, what would that have on the effects of the individual taxpayer's returns? Well, okay, we've seen this chart. Now you got it memorized. Let's move on to the next slide. So what this slide is showing you is a calculation of an individual, and I'm going to show you three different wages, three different incomes, and how the current tax rates fare against the proposed tax law. Again, this is all about understanding what's coming so we can make good, sound decisions from a planning standpoint. So under the current law, if you have income of $65,000, your effective tax rate, you know, Rocky talked about the net effective tax rate, would be about 10.3%, and you'd owe about $3,891. Well, under the new tax laws, your taxes would go up about $794, or in this case, about a 20% increase in the dollars that you're actually paying out in taxes. Well, you might look at that and say, well, that's not too bad. We could deal with that. Well, let's go on to the next income level at 150. So if you're at $150,000, the tax difference between the current rates and the proposed tax rates is about almost $5,900. Well, that's a little bit bigger number right there. And it also represents a 33% increase in the dollars that you're giving in taxes. All right, well, let's go on to the next person. What about an individual who's got income of a little over $477,000? Again, married filing joint. Well, under the current tax laws, we're at a 20.3 net effective tax rate. Under the proposed laws, it goes to 23.6. In this case, they're paying almost $14,000 more, or almost 16% more in dollars paid out in taxes. So it's not a small change when you're talking about going back to the past relative to these tax laws. So what we want to do is we want to be able to anticipate, make sound decisions on the way the policies are moving so we don't get caught with our pants down, right? We want to make sure that we're doing the best we can fiscally to make sure that we keep as much as we can in your pockets from a tax standpoint. So again, do you have a plan? That's just going to be the common thing through this whole presentation here. And planning is everything. Now, let's talk about the capital gains, because there's talk about changing capital gains. Well, our current capital gains rate is based on the income bracket that you're at. If you're at the 10% level, well, there's pretty much no taxes on the capital gains. Same thing with your 12%. Well, that really helps the little guy, right? Because it allows them to ultimately keep more and make ends meet. You get into the 22 through 32% bracket, now you're at the 15% rate. And then when you get to the higher levels, 35 and 37%, you're going to have a 20% capital gains rate. Now, I do need to note here that on income above 441,000, you're also going to get an additional Medicare tax, which is the 3.8%. So that's for income levels over 441. That's where we are today. Now, let's look forward a little bit. If our capital gains rates are sitting here, 23.8 maximum at 441.5 or better, where are we going? Well, the proposed capital gains rates are a little bit vague at this point. We're not really sure how this is all going to shape up. Now, if it shapes up the way they're talking today, well, the new proposal would eliminate the favorable 20% tax rate on people who are making more than $1 million. We're really not clear on anybody below that. But in this case, if you make $1 million, which most people would say, well, that's a lot of money. Well, there's going to be a lot of tax paid on it as well, because you've got 39.6% at the ordinary tax rate, your bracket, plus an additional 3.8%. If you're in the state of Michigan, you add another 4.25%, and you're closely approaching 50% of that money going away to taxes. A lot of money. So that's a big deal right there. Now, let's move forward to the stepped up basis. Maybe you've heard in the news about the fact that they were trying to put the stepped up basis in effect almost immediately. Matter of fact, they were actually putting it in, well, it was in there at one time. It was in the proposals for the COVID relief, this last package that went through. But I think someone figured out that COVID relief plus making someone pay more taxes didn't quite sell very well to the public. So they got that out of there. But I would not expect this to go away. The stepped up basis under the current law provides the full stepped up basis at death. So that's a good thing. That works on everything but retirement type assets. Now, if you go to the proposal says that they would just repeal the stepped up basis altogether. Now, what's not clear is that if you have an estate that falls under the death tax, or your estate is high enough to where they're going to charge a death tax to you, what's not clear is, are you going to get hit with capital gains as well as the death tax? Now, those would be some real big numbers, Rocky, at that point. And that's transitional debt or transitional estates. That's taking your wealth and trying to transfer it to you, but it being sidetracked over to the government. And again, if the government knocks the debt down, we get in good shape from a debt standpoint. I think, you know what, we just got to grin and bear it, right? We got to pull up our bootstraps and do it. But we've got to control the spending at the same time. So let's move to corporate tax rates, because the corporate taxes are looking to go up as well. And I will tell you this is going to affect employees from a business standpoint. So on the corporate tax rate side, the proposal really is to raise the corporate income tax from 21% up to 28%. Now, how does that affect a corporation? Well, some people look at these numbers and say, well, these big corporations should pay more taxes, like the Amazons and the Netflix and such. But this tax rate doesn't just apply to them. It applies to small business owners. It applies to your restaurant down the street. That knick-knack shop down the street that you frequent. It applies to them as well. So it's not just a big business corporate tax. It's any business, large or small, that is paying taxes, that is a corporation. So if you look at this chart here, think of a small business owner. Let's say they have a net profit of $200,000. Well, the additional tax on that profit is 7% or an additional $14,000. Well, okay, the business might be able to absorb that. I mean, $14,000, the owner just gets paid less, right? Well, let's go a step further and talk about some of the other taxes that they're talking about putting into place for corporations. One is the Social Security payroll tax. So again, you go back down to a small business owner. Maybe they're employing, who knows, 50 people, 30 people, whatever the number is. But let's assume they have $100,000 monthly payroll. Well, you multiply that by 12, that gives them $1,200,000 that they're paying out in payroll. Well, the new payroll tax is stating, the Social Security payroll tax is stating that the corporations have to pay an additional 6.2% or doubling that payroll tax. Now, I have to tell you this because this is going to hit employees as well, because the employees also are going to get a doubling of that tax if it goes through the way they're proposing it. So that would be an additional 6.2% tax on the individual's payroll up to, I think the number is somewhere around $107,000 in income. So it's going to affect people on both sides, but let's talk again about the corporation. If you're a business owner and you're paying out an additional $74,000, do you think that business owner might think twice about hiring another employee, which kind of helps the economy, right? Well, I'm here to tell you they are going to think twice about that because $74,000 is literally another employee that you could hire. So it's got long-reaching ramifications when you're talking about the small business owners. Again, do we have a plan? And at the end of the day, it's all about planning to keep as much as you can keep legally following the tax codes. Well, it's something that we're really keen on when it comes to trying to preserve our clients' assets. I mean, everybody has their own circle of wealth. Some are bigger than others, but everybody wants it to grow, right? And at the end of the day, our job is to make it grow. And if we can't get that planning for you, then the odds of growing under a heavy tax environment is going to be more difficult. So that's why today is a good day. 2021 is a very good time to do additional tax planning. Yep. Because the other thing I was thinking about, Rocky, is, and I think we've talked about this with individuals before, and that is, many people have trained the CPA to lower your taxes as low as they can get it the year that you're in. And sometimes when you do that by deferring income out to later days is only deferring the problem to higher taxes. So the planning is the key. You need to be able to see the big picture of how these dollars work together in conjunction with other expenses to allow you to make sure that you're getting every dollar you can to keep it in your estate. I mean, again, I think most individuals do a good job of properly spending And I don't know about you, but I would rather give my money to a charity than give it to the government. And you know, we do, right? We give a lot out, and our clients give a lot out to charities. Which, by the way, kudos to you, because you know, that's what helps our neighbors is being very charitable. So that being said, where are we at now, Rock?
I wanted to add one thing. I was doing a little calculation while you were presenting the proposed going back to the old taxes brackets, and that if you guys remember the $100,000 example I gave you up front of the single person, just a gross income of $100,000, that they would make about or pay about $18,000 in federal taxes, walking through those different brackets. And that's what their tax bill, net tax bill, would be, about 18%. I did the same calculation while Dan was presenting based off of the proposed going back to the old tax structure, and that individual would end up paying on the same $100,000, $20,600. So it's a 2.6% increase on every dollar.
Yeah.
Okay. So it's significant. You know, do you want to keep that $2,600 in your pocket? And that would be double that for a married couple filing jointly.
Yeah.
It'd be just about double versus the single person. So it's, you know, it's a lot to consider, a lot of information we presented to you, but I think we did a good job. And why don't, Dan, you go ahead and tell us more.
Well, you know, at the end of the day, it really comes down to planning, right? And we have done a myriad of webinars. Many of them have different planning strategies in there. And so you can literally go to our YouTube site at Daniel Krug and Associates YouTube. And once you click into that, you're going to have a lot of videos to look at to really refresh your memory on different planning that we have. When you bring up some of them, we've talked about the different tax strategies, you know, reallocating sectors for rebalancing. We've talked about making sure that if you're doing a Roth conversion, that you're maximizing the amount that you can convert long term. And these type strategies, the draw and let heal strategy, all of these are on our website, and you can go back and kind of review these. Or at the next time you sit down in a meeting, you know, maybe we should touch base on different strategies to see where we are. Right. Again, I think when you look at 2021, this may be the last year that we can actually get where we want to go. So
just take advantage of it.
Absolutely. So, you know, that kind of wraps it up. Again, give us a call if you need to give us a call, and we'll walk through anything that we can. If you need to have a meeting with us, just call Caitlin and she'll get you on the books for us. Right.
So just remember, there's no need to worry. You take care of your family, and we will take care of you. We're ready for the future, sitting down with you to build yours, looking forward into 2021 and 2022. So that's it from us. We'll say goodbye to everybody. Thank you for joining, and have a great day.
All right. Thank you.